Welcome to the Techno Fundamental Report for June 29th. You know, baseball has been great in Baton Rouge. The congratulations to the Tigers for winning their national championship. And, there's a lot of analogies with baseball and the stock market and investing. My favorite one is always wait for the fat pitch. In other words, wait for that right situation. Timing is really important. But this was interesting. You are never going to get to second base if you keep your foot safely on first. You've got to move. You've got to take action. Speculation is required. Changing of the guard. Bear markets are difficult. And what really adds to the difficulty is usually it's the end of something and the beginning of something else. So as we look at what's going on with interest rates, we're seeing some really record-setting situations here. I think this is a game changer that will be with us for decades. If you look at the interest rate, the yield on the 10-year Treasury going back to the 1960s, you can see that interest rates rose due to inflation back in the 70s and then peaked around 1980, 1982. Now, interest rates have been dropping ever since. For decades, this interest rate has been dropping. Now, we got down to this ridiculously low level during the COVID pandemic. Basically, they had countries that were going to negative interest rates. Well, last year, 2022, was the worst year for bonds since the 1960s. This looks like a major shift in trend. So, what my point is that the investment strategies that were dependent upon lower interest rates are no longer going to work. It's going to be a completely different ballgame. So it's something to be aware of. Now, Jesse Livermore, who wrote several books but really was a fantastic investor back in the 1920s, he said, "It was never my thinking that made the big money for me. It was always the sitting." So if you think about that, once you're in a bull market, you want to really make an effort to be consistent. So here we have Google as an example, and you can see here that picking up on that buy signal as it broke through that 200-day moving average, it really paid to sit tight. Because as you moved into the stock back then, it was trading around $9 a share. And, if you just were able to sit tight and get through the wiggles, it really was rewarding. So my point is, you want a strategy that is consistent and repeatable. Back in my college days, I took a course in statistics. My professor was Dr. Martin at LSU. We became good friends. And every class for statistics, he would start out we would throw dice, just to try to come up with probabilities and possibilities. So what we think one of the biggest mistakes out there that investors are making is they're watching the media, the internet, the television, and so forth. If you watch CNBC, for example, there are tips every 15 seconds. So watching media for tips or tips from friends can be a random strategy. It's not consistent. Might work well some of the time. I've seen people get tips and they work out really well. Also, predictions are a waste of time and can be deceptive. So in other words, we're hearing all this talk right now about recession. We don't know. They don't know. So the best thing to do is just have a strategy that is consistent and repeatable. Now, I wanted to talk a little bit more about our trend meter that we've been studying. And we introduced this indicator or this meter last week. And here's the price of oil. And you can see here that the West Texas Intermediate is really in a downtrend. Now, the trend meter, the way it's used, you have pink, yellow, green, and dark green. Once you're into the pink, what that means is you're in a definite downtrend. Now, what I like about the indicator, what I've determined so far is it's not a relative indicator. It is an absolute indicator. In other words, all you really do is you look at the numbers. So like right now, I know that the trend meter is telling me that the price of oil is in a downtrend. That's all I needed to know. Now, as we think about this, why would this be important? It's important because we're worried about inflation. Well, the price of gold, the price of oil, I would think it's pretty important. And as you can see here with gold, we were in an uptrend in gold, but we've since, in the beginning of May, have gone into a downtrend in the price of gold. So I'm really wondering how this inflation story is going to unfold. But right now, it looks like to me the market is discounting lower inflation, not higher. This is the Renaissance Fund. This is all the stocks that were IPO'd over the last 2 to 3 years. So these are recent IPOs. These are the growthiest stocks in the market right now. So you can see here the ETF is holding up quite well. Now we did get a pullback for the last couple of days, but it looks like it's starting to break out again. This is a very bullish signal. Now on banks, let's talk about the banks a little bit because I did put the trend meter on the banks. Now you can see here back in March we went into a definite downtrend. We never really got out of it. Now one thing about trend following is trends tend to stay in place for long periods of time. It's like a river flowing. It just flows and then it will reverse. So what you want to look for is that what is the current trend and is it showing any signs of reversing? Well, with the regional banks, we're really not seeing any signs of any reversal of trend. And right now, this is what we would call the no trade zone or the no trend zone. So basically, it was in a banks, the regional banks, been in a downtrend, have popped back to just moving sideways. So you can see what I'm talking about. It's just basically sideways action. Now, yesterday, the Federal Reserve came out with their stress test, and 23 of the biggest banks weathered a very severe stress test. This is one thing I talked about several weeks ago, is that they're really going to go to more of a European model on the stress tests, and they have, and these 23 banks weathered this very severe test. However, the market still just isn't discounting any positive action there. I think the banks are going to be in for a tough time for an extended period of time. Now, one of the things I want to talk about is a real positive. I want to talk about what's going on in the electric car business, the EV. Now, this is a company, one of the things I like to look at when we own Tesla. So I have to disclose that I personally own Tesla. Our firm owns Tesla. And we like to look at what's going on with the competition. Well, this is a company called Rivian. Now, what's interesting about using, again, the trend meter is the stock went public at about, and it rose to $180 a share. It's now down to $14.15. And if you look at the trend meter, you can see once the trend meter kicked in, because there's a period of trading time that has to take place, we barely got into any kind of uptrend, a very minor uptrend here, but it's basically stayed neutral to a downtrend. So the competition in the EV market is really not looking as strong as some of the other companies. Now, this is ChargePoint. This is a company that has the charging stations that are not Tesla charging stations. And we've been hearing a lot of news about Ford, General Motors, Volvo signed up yesterday, and Rivian has actually signed up for the Tesla system. Now, you can see here that with ChargePoint, it really has never gotten into an uptrend. The stock has been in a downtrend for almost the whole year. So you can see here the stock is not acting well. Again, this is the competition. So let's talk about self-driving, full self-driving. Now, this is the old technology. It requires a driver. 2/3 of the cost of a chauffeured taxi is the driver. So you have to use your imagination a little bit here. Back when I first discovered Amazon, I can remember it was 1997. I told people, I said, I hear that, it's a bookstore on the internet and that they might start selling tennis shoes. Well, little did I know that they were going to sell everything under the sun. So you have to use your imagination here. So this is Tesla. These are the charging stations that everybody's crazy about. I've owned a Tesla, and when it comes to self-driving, the electric car really makes a lot of sense for a couple of reasons. For example, the acceleration. It has real real good acceleration. But on the other side, it also has regenerative braking. So I just think that if you're going to do a full self-driving automobile, using an electric platform for your automobile makes a lot of sense, mainly due to safety. Now, these self-driving taxis are being deployed in certain cities. Like the one I'm most familiar with is in Phoenix, Arizona. And that's a joint venture between Uber and Waymo, which is a division of Google. So what I'm saying is, use your imagination here. This may be coming, and I'm of the opinion that it is. Now, as we look at a chart on Tesla, we can see, and I must emphasize, we do own the stock. We basically got a very nice buy signal right in here, came through that 200-day moving average. Now we're getting a slight pullback here recently. There was 3 downgrades this week. But it looks like the stock is going to consolidate. So we don't know yet. If it breaks out up here, that's great. If it breaks down here, we'll have to take defensive action. But Tesla looks to be in the catbird seat when it comes to the future of full self-driving. Now, Uber is another company that is involved in taxis. We all know about Uber. You can get on your cell phone and hail an Uber, but it has a driver in there. Now, Uber is in this joint venture with Waymo. You can see here we got a really strong buy signal here on their earnings report. And as we look at the numbers, you'll see what I'm talking about on the earnings. They're not making money yet, but they're projected to turn a profit this year. Stock's in an uptrend, recently made a new high. Keep an eye on Uber. It's an interesting story. So here are the numbers on Uber. They're losing money. That's a fact. However, they have positive cash flow. That's really important. When you're looking at a young company or a growth stock, in many cases, because of R&D expenses, they're going to lose money, but they actually have positive cash flow. Now, their quarterly revenues jumped nicely, up about 29%. The revenue for the trailing 12 months is about $34 billion. This is about an $80 billion market cap. They've got $4 billion in cash, so they got plenty of cash here. Now, they do have debt. Current ratio is a little bit low. I would like that to be more like 2-to-1, but they've got $4 billion in cash. I don't think they're going to be going anywhere anytime soon as far as negative things. So just be aware of the fact that the company is in a growth mode, and the potential is quite phenomenal for the robo-taxi business. I think it's something we definitely want to keep an eye on. Let me know if you have any questions. Thank you very much.